After 4 decades in finance, I've lived through every major market crash since the early 1980s, the savings and loan crisis, Black Monday in 1987, the dot-com collapse, 2008 financial crisis, and the COVID-19 sell-off. At JP Morgan Chase, managing over $3.7 trillion in client assets, I've developed what I consider the most comprehensive approach to market crash preparation available today. Let me be completely transparent. We are closer to a major market correction than most investors realize. The combination of extreme valuations, excessive leverage, geopolitical tensions, and monetary policy constraints create conditions that historically precede significant market declines. Consider the warning signs flashing right now. The S&P 500 Shiller PE ratio exceeds 30, a level reached only during the 1929 and 2000 market peaks. Margin debt has surged to record levels exceeding $900 billion, meaning retail investors are more leveraged than ever before. The CNN Fear and Greed Index consistently shows extreme greed, while the VIX Volatility Index remains compressed below 20, suggesting dangerous complacency. Most investors are completely unprepared. They're holding portfolios optimized for bull markets with growth stocks trading at 30, 40, even 50 times earnings. They have minimal cash reserves, no hedging strategies, and allocations that will get crushed when sentiment shifts. I've seen this movie before. It never ends well for the unprepared. At JP Morgan, we've analyzed every major crash over the past century. The institutional investors, sovereign wealth funds, and billionaire families that survived and profited followed specific protocols that protected capital during declines and deployed resources at attractive prices during recovery. Today, I want to share the 4 critical moves you must make before the next crash hits. These aren't suggestions, these are essential actions that could mean the difference between preserving wealth and watching decades of savings evaporate. The current market environment exhibits characteristics that have historically preceded major corrections. The S&P 500 trades at over 25 times trailing earnings, well above the long-term average of 16 times. Speculation throughout the system includes maxed out retail margin debt, excessive options trading, and crowded institutional positions. What's particularly concerning is the concentration risk building in mega cap technology stocks. The top 10 S&P 500 companies now represent over 30% of the index, a concentration level not seen since the late 1990s dot-com bubble. When these names fall, they'll take the entire market down with them. The corporate bond market shows extreme stress with investment-grade credit spreads at multi-year lows despite rising default risks. High-yield bonds trade at yields barely compensating for inflation, let alone credit risk. This mirrors conditions before the 2008 credit crisis when investors reached desperately for yield. Monetary policy has reached its limits. The Fed faces an impossible choice between fighting inflation through higher rates that trigger recession or accepting persistent inflation that destroys purchasing power. The recent banking sector stress from Silicon Valley Bank and Credit Suisse demonstrates how quickly financial stability can unravel when interest rates rise rapidly. Geopolitical risks are multiplying. Ukraine conflict escalation, China-Taiwan tensions, Middle East instability, and domestic political polarization create multiple crash triggers. Any one of these situations could escalate rapidly and cause global market volatility that spreads across all asset classes. Corporate earnings growth is slowing as companies face higher borrowing costs and increased expenses. Many companies that benefited from pandemic trends are seeing revenue growth decelerate while costs remain elevated. This earnings recession could trigger significant multiple compression across equity markets. The banking system faces stress from commercial real estate exposure and underwater bond portfolios. While major banks like JP Morgan are well capitalized, regional banks face significant challenges that could create broader financial system instability reminiscent of the savings and loan crisis. Most importantly, investor sentiment shows excessive optimism, while volatility measures suggest dangerous complacency. The AAII sentiment survey shows bullish sentiment consistently above 50%, while the VIX term structure indicates investors are paying minimal premium for downside protection. Move 1, build substantial cash in short-term treasury positions. The first critical move is building substantial cash and short-term treasury positions representing 15% to 25% of total portfolio value. This isn't money sitting idle. This is strategic dry powder providing psychological stability and opportunity during market stress. Let me be specific about implementation. For a $500,000 portfolio, you should target $75,000 to $125,000 in cash equivalents. For a $1 million portfolio, that's $150,000 to $150,000. This feels like a lot when markets are rising, but it becomes your most valuable asset when everything else is falling. Cash allows rational decision-making when portfolios are declining rapidly and provides capital to buy quality assets at discounted prices during panics. During March 2020, investors with cash could buy Apple at $224, now over $170, Microsoft at $132, now over $280, and Amazon at $1,626, adjusted for splits, equivalent to buying it at massive discounts. At JP Morgan, we focus on Treasury securities with 90-day to 2-year maturities for crash preparation. 3-month Treasury bills currently yield over 5%, providing income superior to savings accounts while maintaining perfect safety and liquidity. The iShares 1 to 3 year Treasury bond ETF SHY provides professional management and daily liquidity with an expense ratio of just 0.15%. For larger portfolios exceeding $1 million, consider laddering individual Treasury securities through Treasury Direct. Purchase $25,000 to $50,000 blocks of Treasury bills maturing every 3 months, creating a steady flow of cash that can be redeployed as opportunities emerge during market stress. Short-term Treasuries also benefit from flight to safety during crashes when investors flee to government bonds. During the March 2020 crash, long-term Treasury bonds gained over 20% in 3 weeks as investors panicked out of stocks and into safety. International cash equivalents provide additional diversification when crashes involve dollar weakness. Swiss franc deposits through major banks, German government bonds, and other safe haven currencies can provide protection when market crashes coincide with domestic policy mistakes. The Invesco Currency Shares Swiss franc Trust FXF provides simple exposure to Swiss franc strength. Building cash positions requires discipline because they underperform during final bull market stages, but accepting short-term opportunity cost avoids long-term capital destruction. During the dot-com bubble's final year in 1999, cash earned 5%, while the Nasdaq gained 85%. But in 2000-2002, cash preserved wealth while the Nasdaq lost 78%. The timing is critical. At JP Morgan, we recommend building these positions gradually over 6 to 12 months when warning signs emerge, rather than waiting for obvious market stress when it's too late to sell risk assets at reasonable prices. Shift to quality and defensive equity positions. The second critical move is systematically shifting equity exposure toward quality companies in defensive sectors that weather economic downturns while reducing exposure to speculative growth stocks that get crushed during crashes. During market crashes, companies with strong balance sheets, stable cash flows, and essential products decline less than the overall market. At JP Morgan, we've analyzed performance during every major crash since 1929. Quality defensive companies consistently outperform and recover more quickly. Utility companies represent classic defensive investments. NextEra Energy, NEE, operates essential electricity generation and transmission infrastructure across Florida and other growing markets. The company has increased its dividend for over 25 consecutive years, currently yielding 2.8% with strong coverage ratios. Southern Company SO provides electricity and natural gas to growing southeastern markets, yielding over 4% with investment-grade credit ratings. During the 2008 financial crisis, utilities declined only 28%, while the S&P 500 fell 57%. In the COVID-19 crash, utilities dropped just 18% versus 34% for the broader market. The Utilities Select Sector SPDR Fund XLU provides diversified exposure to this defensive sector. Consumer staples, companies like Procter & Gamble, PG, and Coca-Cola KO, sell necessities that consumers purchase regardless of economic conditions. P&G has increased its dividend for 67 consecutive years, currently yielding 2.4% while maintaining dominant market positions in household products. Walmart, WMT, benefits from consumers trading down during economic stress, often seeing market share gains during recessions. The Consumer Staples Select Sector SPDR Fund, XLP, holds these defensive stalwarts and has historically outperformed during market stress while providing steady dividend income averaging 2.5% to 3%. Healthcare companies, particularly large pharmaceuticals like Johnson & Johnson, J&J, and Pfizer, PFE, address medical needs that persist regardless of economic conditions. J&J has increased its dividend for 61 consecutive years, currently yielding 2.9%, while maintaining diverse revenue streams from pharmaceuticals, medical devices, and consumer products. The Healthcare Select Sector SPDR Fund XLV provides broad healthcare exposure and typically declines less than the overall market during crashes, while benefiting from aging demographics driving long-term growth.
Technology requires careful selection. Microsoft, MSFT, and Apple, AAPL, have evolved into quality companies with massive cash reserves exceeding $100 billion each, strong competitive moats, and diversified revenue streams.
But avoid speculative growth stocks with no profits and sky-high valuations that typically lose 60% to 80% during crashes. The Invesco QQQ Trust, QQQ, which tracks the NASDAQ 100, provides exposure to large-cap technology companies but requires careful monitoring during market stress. The Vanguard Dividend Aristocrats ETF Nobel focuses on companies that have increased dividends for at least 25 consecutive years. At JP Morgan, we recommend focusing on companies with debt-to-equity ratios below 30%, return on equity exceeding 15%, and consistent earnings growth over at least 10 years. These metrics help identify companies with financial strength to survive and gain market share during downturns. Defensive positions should represent 60% to 75% of total equity exposure before market stress emerges, meaning if you have 60% of your portfolio in stocks, at least 35% to 45% should be in these high-quality defensive names. Move 3, implement strategic hedging and volatility protection. The third critical move is implementing strategic hedging that provides downside protection during market declines while maintaining upside participation if markets continue rising. The simplest hedging strategy is purchasing put options on broad market indices like the S&P 500. Put options provide portfolio insurance that pays off when markets decline significantly. At JP Morgan, we recommend purchasing puts with strike prices 10% to 20% below current levels and 6 to 12-month expirations. The SPDR S&P 500 ETF SPY offers liquid options markets for individual investors. A typical hedge involves put options representing 25% to 50% of equity exposure, costing 1% to 3% of portfolio value annually. This cost should be viewed as insurance premium rather than investment expense. Volatility ETFs like the ProShares VIX Short-Term Futures ETF, VIXY, provide another hedging tool. These instruments can provide substantial returns during crashes. The VIX increased over 400% during March 2020 and over 250% during 2008. However, they typically decline during normal conditions and should represent only 1% to 3% of portfolios.
Gold and precious metals provide hedging during crashes, particularly when combined with currency debasement or systemic risk. The SPDR Gold Shares ETF GLD provides direct gold exposure, while the VanEck Vectors Gold Miners ETF GDX offers leveraged exposure through mining companies.
International diversification provides geographic hedging against domestic crashes. The Vanguard Total International Stock ETF and iShares MSCI EAFE ETF provide broad international exposure that may outperform during U.S.-focused market stress. At JP Morgan, we recommend hedging strategies represent 5% to 15% of total portfolio value. Successful hedging requires understanding that costs reduce returns during normal conditions but provide crucial protection during crashes. Move 4, position for post-crash opportunities and recovery. The fourth and most important move is positioning your portfolio to take advantage of extraordinary opportunities that emerge during market panics when excellent companies trade at temporary discounts due to forced selling and liquidity constraints. The greatest fortunes in investment history have been built by investors who had capital and courage to buy quality assets during crashes when others were selling in panic. Warren Buffett, John Templeton, and other legendary investors made their largest returns purchasing exceptional companies at crisis prices during downturns. At JP Morgan, we've studied every major crash over the past century and identified consistent patterns. Quality companies with strong competitive positions often decline 30% to 50% during crashes, despite maintaining fundamental business strength. These price dislocations create opportunities to purchase excellent companies at prices impossible during normal conditions. Technology leaders like Microsoft, Apple, and Google declined 40% to 50% during 2008 despite maintaining strong fundamentals. Investors who purchased these companies during crisis achieved extraordinary returns over the subsequent decade as both business performance and valuations recovered. High-quality financial companies, consumer staples, and healthcare companies often become temporarily undervalued during panics despite their defensive characteristics. The key is identifying companies with financial strength to survive downturns and competitive advantages to thrive during recovery. Real estate investment trusts typically experience severe declines during crashes as investors flee perceived risk, creating opportunities to purchase income-producing assets at substantial discounts to underlying property values. High-quality REITs owning essential infrastructure like data centers and industrial properties often decline 50% to 70% despite owning assets generating stable cash flows. Corporate bonds from high-quality companies also present opportunities when credit markets freeze and prices decline despite minimal changes in underlying credit quality. Investment-grade bonds from companies like Johnson & Johnson and Microsoft can trade at yields exceeding 6% to 8% during crisis periods. International markets often provide exceptional opportunities during U.S.-focused crashes, particularly in countries with strong fundamentals that become temporarily undervalued due to global risk aversion. European, Asian, and selected emerging markets can provide both diversification and return potential during U.S. stress. Implementation requires both capital preservation and psychological preparation before crashes occur. Investors must have sufficient cash reserves while maintaining emotional discipline to buy when others are selling in panic. At J.P. Morgan, we recommend maintaining detailed watch lists of high-quality investments with predetermined price targets that would trigger purchases during declines. Successful post-crash investing requires patience because the best opportunities emerge during the most psychologically difficult periods when negative news flow is intense and sentiment is extremely pessimistic. The ability to buy during these periods separates successful long-term investors from those who succumb to emotional decision-making. Position sizing should be substantial enough to meaningfully impact long-term returns, but gradual enough to avoid investing all capital too early. Dollar cost averaging into positions over several months during stress can provide better average prices than attempting to identify exact market bottoms. Recovery from crashes typically occurs more rapidly than most investors expect, making it crucial to position for opportunities before stress emerges rather than waiting until after declines begin. Investors who benefit most from post-crash opportunities are those who prepare systematically while markets are rising rather than reacting after crashes have occurred. Your success implementing these four critical moves depends on acting before market stress becomes obvious to all investors. The time to prepare for crashes is when markets are rising and complacency is high, not when crashes are underway and preparation becomes impossible. Remember that market crashes, while painful, create the greatest investment opportunities available to systematic investors who prepare properly. The combination of defensive positioning, adequate cash reserves, strategic hedging, and post-crash opportunity preparation can transform crashes from wealth destroyers into wealth creators for disciplined investors who understand and implement these principles systematically. The choice is yours. Watch the next market crash destroy your wealth like most unprepared investors, or position yourself to not only survive but thrive during market stress by implementing these four critical moves before it's too late.